Every day, people around the world make more than 2 billion digital payments. They pay for goods and services, borrow and save, and engage in a multiple of financial transactions. Every time they do so, they rely on the monetary system, the set of institutions and arrangements that surround and support monetary exchange. Unusual public debt levels, uncontrolled money supply expansion, and the enormous financial imbalance render our current financial system extremely unstable. As politicians, banks, and central banks worldwide are running out of realistic and effective solutions, we are left to deal with the rising inflationary pressures and continuous debt creation at the expense of the next generation. The unprecedented creation of money out of thin air and the politically motivated interest rates manipulation by central banks have a direct impact on the value of our money. How is the present monetary system affecting the economy, society, and nature, and why is it failing? I will answer all these questions in few points. First of all, money is created as debt. Today, money comes into existence by debt creation when commercial banks borrow from central banks and when governments, producers, or consumers borrow from commercial banks. When you take out a loan, new money is created. As people borrow more new money comes into the economy. All the extra spending on these newly created money funds gives people the impression the economy is doing well, which encourages them to borrow even more. As the debt goes up, so does the amount of money. Because banks create money when people borrow, for every pound of money in the economy, there will be a pound of debt. If there is 100 pounds in your bank account, someone else must be 100 pounds in debt. Across the world economy, there will be as much debt as money. If we need to get more money into the economy, for example during a recession, then we have to go further into debt to the banks. This is why the government is desperate to get banks lending again. If banks start lending more, they will create more new money in the process, and the people who borrow will spend this new money. When you pay down your debt, the money that leaves your bank account doesn't go to anyone else, it just disappears. This is because loan repayment are just the opposite process to money creation. Banks create money when they make new loans and effectively destroy money when they repay loans. So when lots of people try to pay down their debts at the same time, money disappears from the economy. When this happens, it's like draining the oil from the engine of a car. Pretty soon, everything stops working. This means that it's almost impossible to reduce our debt without causing a recession. And you personally can only pay off your debt using money that was created when someone else went into debt. This creates a debt trap when over time the level of personal debt in the economy has to keep growing. The money supply is under private control. Only a small fraction of the money circulating in public has been created by central banks. Central banks issue coins and banknotes, which in most countries accounts for just between 5% and 15% of the money supply. The rest is created by commercial banks in an electronic form as accounts money when granting loans to customers or buying securities and goods. In fact, all money, whether cash or account money, is brought into circulation by commercial banks. Therefore, commercial banks control the money supply. However, commercial banks decide which customers are granted loans and which investments are made according to their interest in maximizing their own profits. Whether an investment is socially desirable is definitely not the most important factor for commercial banks. This way, investments serving to common good but not being profitable enough are not supported by the banking system and have to be financed by government spending that depends on tax revenue and public debt creation. Instead of financing long-term investment in the interest of society as a whole, commercial banks with their credit business support short-term financial speculation and over the last 2 decades have actually established a gigantic global casino beyond any public control. The money supplies support economic cycles. Commercial banks issue loans by creating account money in order to maximize their interest revenue. The more money they issue, the higher their profits are, as long as the debtors are able to pay. When there is economic growth, banks are issuing a lot of loans so they can profit from the economic booms. During economic declines, their number of credit is very restrictive in order to reduce their risk. This is how banks bring an oversupply of money into the market during the expansion and an undersupply of money in a recession, influencing business cycles as well as financial market fluctuation and creating asset bubbles in real estate and commodities, which may cause heavy damage to society and to the banking system itself when they burst. The best example is the 2008 mortgage-triggered banking crisis after the burst of the US real estate bubble. The money supply triggered inflation. There is a strong link between the money supply and inflation. If the money supply rises faster than real output, then prices will usually rise. This means if a central bank prints more money, we will often get higher inflation. Besides its pro-cyclical character in the short term, in the long term, the money creation of commercial banks induces an oversupply of money that leads to consumer price inflation as well as asset price inflation. An oversupply of money appears if the increase in the quantity of the money in circulation exceeds the growth of the production of goods and services. The long-term oversupply of money results not only from traditional granting of credit to governments, corporations, and individuals, but also from credit leverage, financial speculation of hedge funds and investment banks. Due to inflation, consumers usually face an annual loss of purchasing power, which means that they have to increase their nominal income in order to maintain their level of consumption. Inflation causes a redistribution of purchasing power to the disadvantage of those individuals who are not in the position to effectively advocate for their own interests. The privilege of creating money is a subsidy to the banking sector. A subsidy is a benefit given to an individual, business, or institutions, usually by the government. It can be directed, such as cash payment, or indirect, such as tax breaks. The subsidy is typically given to remove some type of burden, and it is often considered to be in the overall interest of the public. Who has control over the supply of new money and what benefit does it bring? There is now widespread acceptance that in modern economies, commercial banks, rather than the central banks, creates the majority of the money supply. Since money is debt, it carried interest. Therefore, interest has to be paid on all the money in circulation, and nobody can escape paying interest. Interest is primarily paid by customers who take loans from commercial banks and ensure the money supply. Secondly, everybody who pays taxes and buys goods and services makes a contribution to the interest payments of the original borrower, because taxes have to be raised partly in order to finance the interest payment on sovereign debt. Furthermore, corporations and individuals providing goods and services must include the cost of their loans in their prices. This way, by using money, society pays an enormous subsidy to the commercial banks. Interest is a subsidy to the bank because the account money they create is handled as a legal tender. The magnitude of the subsidy society pays to the banks is reflected in the disproportionately high salaries and premiums of bankers, as well as the disproportionately large banking sector. Interest encourages wealth concentration. Interest is the money charged for the privilege of borrowing money. Interest expense or revenue is often expressed as a dollar amount, while the interest rate used to calculate interest is typically expressed as an annual percentage rate, APR. Interest is the amount of money a lender or financial institution receives for lending out money. Interest can also refer to the amount of ownership a stockholder has in a company, usually expressed as a percentage. Not only the customers who borrow money from banks, but also the bank which hold customer deposit pay interest. When commercial banks create money by granting loans, they credit customers' account and expand the total of bank deposit. Since accounts usually carry interest, the banks spend a part of their interest revenue for interest payment to the account holders. Now, banks' deposit and loans are not equally distributed among the customers. Some have mainly loans they pay interest on, whether others mainly have deposit they earn interest on. Because in general, poorer people have more loans than deposit and richer people have more deposit than loans. Interest payments are in effect a transfer of money from the poor to the richer people. This concentration of wealth favors the commercial banks, which make investments themselves and earn the amount resulting from the considerable interest spread between borrowing and lending rates. But monetary assets do not grow in value by themselves since they are not productive. Value increase interest on monetary assets can only be generated through human labor, and human labor is always under a monetary pressure to increase its productivity and lower its cost of functioning to satisfy the demand of exponentially growing compound interest. Interest is therefore a value transfer that favors capital investment to the disadvantage of labor income. The monetary system is unstable. Financial stability might sound confusing, but it's just a way of describing the financial system when it's fulfilling its basic roles. With a stable financial system, the wheels of the economy keeps turning even when the conditions get difficult. It can be difficult to spot when things are unstable. It might only become obvious when conditions on the road get tougher and then things start to go wrong. Hidden weaknesses can leave the financial system vulnerable if financial institutions are not prepared for unexpected events. If one area of the financial system is weak, problems can start to spread or multiply. This can disrupt the services which households and businesses rely on for their day-to-day needs. For example, you might find it harder to get a mortgage or save enough for your retirement. The global financial crisis of 2007-2009 shows that financial instability can severely affect lots of people's jobs and lives. The monetary system violates ethical values. An ethical value is something that is seen as valuable from a general perspective after careful consideration. Ethical value embody the most rational and most important value of society. Therefore, society is inefficient if its monetary values are in a permanent conflict with its ethical values, and these ethical values are permanently under pressure because of the monetary values. Since the monetary system shapes the economy and the economy forms society, ethical values not contributing to the profitability of capital are systematically neglected in today's policy making. This way, our current monetary system violates ethical values such as stability, justice, and sustainability, values that are essential for sustainable society. A monetary system that breaks these values is quite unreasonable and should be reformed as soon as possible. Let me know in the comments below what is your opinion about the current monetary system. Thank you so much for watching. As always, if you find this content helpful, smash that like and subscribe button, turn on the notification bell to be notified every time I post a new video, and see you in the next video.